What caused the stock market crash of 1929? Have you ever wondered how a thriving economy can suddenly collapse? The stock market crash of 1929 is a perfect example of this phenomenon. Let's break down the causes and see how they connect to sociological research methods and historical analysis. First, we need to look at the culture of the 1920s. After World War I, the economy boomed, and people felt optimistic. This led to many individuals investing in the stock market, often without fully understanding the risks involved. Many borrowed money to buy stocks, a practice known as margin buying. This widespread participation created a speculative culture where everyone believed they could get rich quickly. Next, we have the issue of overproduction. Factories produced more goods than people could buy. Industries like automobiles and consumer goods saw massive production, but demand did not keep up. At the same time, farmers faced a crisis. Falling crop prices and overproduction hurt rural communities, reducing their ability to spend. This imbalance created vulnerabilities in the economy that the crash later exposed. Banking practices also played a significant role. Banks were giving out risky loans, often using depositors' savings as collateral. When stock prices began to fall, investors were forced to sell their shares at a loss. This panic selling led to bank failures as loans defaulted, eroding public trust in financial institutions. As banks collapsed, access to credit dried up, leading to increased unemployment and a drop in consumer spending. Media influence cannot be overlooked. Newspapers and radio promoted stocks as safe investments. When the market began to crash, the same media outlets reported on the panic, which only made things worse. This shift from optimism to despair shows how collective psychology can impact economic events. Lastly, we must consider the social context. Wealth inequality was rampant during the 1920s. Most financial gains went to the wealthiest individuals, leaving lower-income families struggling with debt. The absence of social safety nets, such as unemployment insurance, meant that job losses hit hard. Families faced poverty, which altered their dynamics and community structures. From a sociological perspective, the crash illustrates how cultural norms, institutional practices, and structural inequalities can converge to create risk. Researchers studying this period often focus on how these elements eroded social cohesion and reshaped class relations. The demands for government intervention during the Great Depression were a direct response to the failures exposed by the crash. In practical terms, sociologists might look at how the events of 1929 relate to modern financial crises. They can analyze how speculative behavior and media narratives repeat in different contexts. Oral histories and economic policy archives can provide a clearer picture of how individuals and institutions rationalized their actions before and after the crash. Understanding the causes of the stock market crash of 1929 not only helps us learn from history but also offers a framework for analyzing future economic events. By examining the interplay between economic structures and societal behavior, we can better grasp how crises emerge from collective actions and institutional designs.